It's crunch time for China. Fresh manufacturing data shows factories are feeling the pain of a weaker global economy. Few analysts expect an economic meltdown in 2012, but they do expect more policy action from Beijing. Manpreet Gill of Standard Chartered.
Let's not forget they're potentially one of the very few major economies left where the government retains quite a bit of capacity to act in case growth does fall off in a sharper fashion.
So what to expect? First up, cuts in the so-called required reserve ratio, the money banks are ordered to hold. Also expect some stimulus, not the lending binge of 2008, but more targeted measures, including lowering overall debt. That's according to Victor Shvets of Samsung Securities.
In the next quarter, there will be at least 2 or 3 cuts in RRR reserve requirements as a minimum. You're also going to have some of the administrative controls being released, such as some of the home purchase restrictions are going to be eased.
Growth will be a priority in 2012, but authorities can't ignore inflation. CPI appears to have peaked, but it still remains above the central bank's target of 4%. It means an interest rate cut is unlikely unless growth falls sharply.
There's a realization that inflation does also need to be kept in check, particularly if we see another bout of quantitative easing in the Western world. So we think that's a good reason why growth is likely to be a little more subdued than what it is otherwise.
With little sign of recovery in Europe and growing challenges at home, China's policymakers are facing tough times. How they respond will be critical in 2012. Tessa Dunlop for Reuters.